Let's kick things off with a story, one that might hit a little close to home. Picture two brothers, Jake and Mike. Back in March of 2022, they both decided to check in on their investment accounts. Now, here's the thing. They had both invested the exact same amount of money over the exact same period of time. But what they saw on their screens? Well, it couldn't have been more different. So Jake, who'd done everything by the book, consistently investing in S&P 500 index funds, was staring at a loss of almost $5,000. Ouch. Meanwhile, his brother Mike was up a staggering $22,000. We're talking about a difference of over $26,000. That is a massive swing, especially when you remember they started from the exact same place.
So what gives? How does this happen? Same family, same starting capital, same timeline, but wildly different results. The answer, it turns out, lies in this really powerful but little-known idea about how wealth actually moves during a market crash. And it's probably not what you're thinking. It's a concept called the crisis transfer theory, and the core idea is a total game changer. Wealth isn't actually destroyed in a crash, it's transferred. It literally moves from the accounts of investors who are caught unprepared over to the accounts of those holding a few very specific safety assets before the storm hits. And this transfer, it happens in three pretty predictable phases. First, you get the collapse, right? That's when it feels like everything is just plummeting. Then you see what's called the flight to safety. This is when the big institutional money, we're talking billions, has to find a secure place to park its cash. And finally, you get the wealth transfer itself, where those specific safety assets surge in value while almost everything else is burning. Okay, so what exactly makes an asset safe in the eyes of all that smart money? Well, it really just boils down to three key traits. It has to have tangible scarcity, something you can't just print more of. It has to have essential utility, meaning people need it no matter what the economy is doing. And it needs to have a long, proven history of weathering previous economic collapses. All right, let's dive into the four assets that actually fit this profile. The first one might surprise you a little. It's not physical gold itself, but actually the stocks of the companies that are digging that gold out of the ground. And this is where the numbers get absolutely insane. During the Great Depression, while the Dow Jones lost a catastrophic 89% of its value, one of the biggest gold miners at the time, Homestake Mining, was up 474%. No, that is not a typo. Up over 400% while the world was falling apart. The logic here is actually pretty simple. In a crisis, people panic and flee to the perceived safety of gold, right? That drives the price of gold way up. But the cost for these companies to actually pull that gold out of the ground, that stays relatively stable. The result? Their profit margins just explode, and their stock prices can go absolutely parabolic. And this is the really honest part. You have to understand this. Gold miners are incredibly volatile. They are a specific tool for a specific job, surviving a crisis. They are absolutely not something you just buy and hold on to forever. Okay, let's move on to our second asset. And I'll admit, this one sounds kind of boring. Long-term U.S. Treasury bonds. But trust me, their performance during a certain type of crisis is anything but boring. Just take a look at the 2008 financial crisis. The stock market was getting cut in half, down a brutal 57%. But long-term government bonds, they actually delivered a positive return of over 14%. This is a textbook example of that flight to quality we mentioned earlier. When the big institutions with billions of dollars get scared, they have to put that money somewhere they consider absolutely unequivocally safe. And historically, that safe harbor has been U.S. government debt. All of that demand just drives prices way, way up. But here comes a massive caveat. Bonds are a hedge against a deflationary crisis, like 2008 was. They get absolutely crushed in a high inflationary environment, which is exactly what we saw in 2022. And this is precisely why you can't just rely on a single crisis asset. You need a toolbox. So, what else is in that toolbox? Asset number 3 is about as tangible as it gets. U.S. farmland. It's an asset that billionaires like Bill Gates have been quietly scooping up for years, and for a very good reason. The data from the Great Recession says it all. While the stock market was in a total freefall, U.S. farmland delivered a positive return of nearly 16%. The why behind this is pure common sense. They're not making any more of it, the global population keeps growing, and everybody always needs to eat.
All right, our final asset is one that some people might call boring, but let me tell you, in a crisis, boring is beautiful. We're talking about the stocks of companies that make consumer staples. You know, things we all buy no matter what the economy is doing, like toothpaste, toilet paper, and soap.
Now look, these stocks didn't magically go up during the 2008 crash, but they played incredible defense. They only fell by about 28%, compared to the market's 57% plunge. And that difference is just massive, because losing less means you recover exponentially faster. A 57% loss requires a 132% gain just to get back to even. That is a huge mountain to climb.
So let's put all this together. This right here, this is the standard portfolio for millions and millions of people. A simple 60% in stocks, 40% in bonds. It's supposed to be balanced, and you know what? It works great, until it suddenly doesn't. Because in a really bad crisis where both stocks and bonds happen to fall at the same time, a portfolio like this could lose nearly half its value. Just imagine that for a second. Watching years of your hard-earned savings just get vaporized. That's the painful reality that Jake experienced. But what if you took just a part of that portfolio and specifically allocated it to defense? Well, this is what a more crisis-ready portfolio might look like. You still have your core holdings, of course, but you dedicate a slice to each of the 4 assets we've talked about. This isn't about predicting the future, it's about building a defense.
So what's the tangible takeaway here? The idea is to consider allocating maybe 10 to 20% of your portfolio to these kinds of defensive assets. And you don't need to be a billionaire to do it, not at all. There are simple ETFs and stocks for each category, like GDX for miners or XLP for consumer staples, that you can go research.
And you don't have to just guess when a crisis might be around the corner. History shows there are some pretty reliable signals to watch for. The big one is the yield curve. Normally, you get paid more interest for lending your money for a longer time. But sometimes that flips. It inverts, which is a classic recession warning. But here's the key. The real signal isn't the inversion itself. It's when it starts to go back to normal. Historically, that has been the final warning shot.
Let's bring this all the way back around to where we started, with Jake and Mike. The core lesson in their story is this. The market isn't a single game. There's the game you play in the good times, the bull market, which is all about growth. And then there's the entirely different crisis game, which is about safety, survival, and finding opportunity in the chaos. The problem is, most of us are only ever taught the rules for the good times. We're handed a playbook that works great, right up until the moment it leads to absolute disaster. The investors who build real, lasting wealth are the ones who understand how to play both games. So the question to ask yourself is, which playbook are you using?